Hi, everyone, and welcome to our expert M&A panel discussion for seller preparedness and post-closing considerations in 2021. I'm going to start with a brief introduction. My name is Becky Stifter. I'm an attorney at Michael Best and Friedrich LLP, focused on transactional law, including venture law financings and M&A transactions. We have an expert panel here today. I'm super excited to introduce and preview the topics that we will cover. Our discussion is all about new year, new deals. We'll focus on sourcing deals and a pathway to closing. Our speaker, Cassie Dobis, who's an investment banking associate at Forbes M&A, will focus on lessons learned from 2020 and projections for 2021 regarding sourcing and closing deals from the investment banker's perspective. Our next phase will discuss pre and post-closing operations and integration. Vanessa Davison, Managing Director of Panama Consulting, and Soraya Yahaya, Founder and CEO of Kazana Inc., will focus on pre and post-closing operations, best practices for sellers, and post-closing integration considerations for buyers. Our last phase will focus on wealth planning and management considerations. We have two experts in wealth management here with us today, Hope Hanrahan and Tierney Aldridge. Tierney is the risk management advisor at Denver Agency, and Hope Hanrahan is a wealth management advisor at Merrill Lynch Wealth Management. Their discussions will focus on pre and post-closing preparedness and post-closing considerations from a wealth management and financial planning perspective. I'm going to let the panelists go through really quick and do a brief intro of themselves, and then we will jump into a market review of 2020 and a look forward at 2021 for M&A. Hope, I'll have you start.
Hi, everyone. My name is Hope Hanrahan, and I work with an incredible team out of Boulder, Colorado at Merrill Lynch. We have clients who were once business owners or still are, and they reside all over the country. And I'm really excited to be here, given all of the volatility and uncertainty of 2020. I hope that we can provide some insight and some helpful information for everyone who's taking the time to watch today. So thanks for having me.
Wonderful. Thank you. Vanessa, can you go next?
Hi, everyone. I'm Vanessa Davison, Managing Director at Panorama Consulting Group, and I lead our turnaround and restructure practice and post-merger integration practice as well. And we're looking forward to really giving you some great insights for 2021, lessons learned for 2020, and what we're going to see in terms of what makes you successful in terms of merging or going through an acquisition event.
Thanks, Vanessa. Tierney, you're next on my screen, so I'll jump it over to you.
Excellent. Hi, I'm Tierney. I'm with Denver Agency. I specialize in working with high and ultra high net worth families who are oftentimes business owners as well. So I'm excited to be a part of this panel and to discuss what's going on in the insurance industry.
Thank you. Cassie?
Hey, good afternoon. I'm Cassie Dobis with the Forbes M&A Group. I'm a Colorado native, so I love being part of an investment bank based in Denver like Forbes. And I'm just excited to be here and share my experience advising companies through mergers and acquisitions, including this whirlwind 2020.
Thank you. And Soraya?
Hi, everyone. I'm Soraya Yahaya. I own my own fractional COO firm. Also integrator for EOS companies. I am embedded in several small and medium-sized businesses right now as their fractional chief operating officer. So I'm in a leadership role dealing with issues such as pre and post-closing integration and operational matters, and looking forward to share some of that expertise with you.
Thank you, everyone. So we'll get kicked off with our first question to Vanessa, Soraya, and Cassie. Focused on 2020 lessons learned, among the laundry list of items and lessons learned from 2020, what are some of the key insights that your team experienced in 2020 when counseling clients through M&A transactions on both the buy side and the sell side, and what lessons will carry forward to advising clients in 2021? I think Vanessa, you can kick us off.
Yes, absolutely. Well, what we've seen in our experience is really a return to back to basics. What we've seen in the past is companies get enamored with other companies to merge for the shiny, bright object, but we're seeing more of a back to basics in that it is more of a disciplined approach at transactions, looking at your core competencies and focus on profitable channels, prioritizing strategic deals to shore up their standalone organic growth through that acquisition in order to maintain market share or grow while others are contracting. So there's a lot of opportunities there. Merging became a good way to utilize economies of scale to survive and grow. And that's what we're seeing a lot, probably because we are engaged during a pre-merger and post-merger transaction. Soraya, what would be your point of view?
Yeah, totally agree on that. I think we saw the same. Some companies were contracting, especially when you're looking at small businesses. Last year was very challenging, and some companies were contracting. Those that were fortunate enough to come into the pandemic prepared and had planned to ride out something like that, they were very bullish. Fortune favors the bold and the prepared. And we saw a lot of acquisitions where companies were maybe buying up the competition, shoring up product capabilities, expanding reach, increasing market share. And I think we're going to see this, and this advice holds true as well for 2021. Be bold, be prepared. Downturns can favor those who are well prepared and have planned. And it can be a good market to opportunistically take some of that market share away from competitors.
Yeah, and something a little different that we definitely saw was really around the impact of emotions. And so M&A transactions with owners are usually a pretty personal thing. You're selling your baby that you've had for 5, 10, 20 years. And so that being coupled with, heightened stress around the pandemic has been really interesting to see. But I do think going into 2021 and beyond, it would be good to keep those at the forefront, really as a consideration for both buyers, sellers, and really just the people that are making those key decisions throughout transactions.
Thank you all. Yeah, I think this next question, we're looking into 2021, and I'll ask, Soraya, Cassie, and Hope. 2021 is really expected to be a hot year for M&A as deal makers are attempting to recover from the ongoing pandemic. Just curious, what are some of the predictions that your team is making for 2021 in light of this current industry prediction?
Yeah, I'll go first in this one. I think that what we're telling our clients is that fundamentals are still what is going to drive valuations. And companies that are operationally efficient, are diversified, have been prepared to ride out challenges, will continue to be the most attractive. I think we'll talk in a little bit about the effect of the pandemic and that it's kind of highlighted and maybe brought to the forefront some of that, shiny objects that Vanessa was talking about. But I think regardless, companies that are still strong with cash reserves, have good returns, are efficient, have good alignment, deliver well to customers, are going to be attractive.
Cassie, what's your take?
Yeah, I'd agree. We had a lot of success in 2020, which was great, but really around businesses that had compelling growth stories or were at an interesting inflection point, launching new products and services that made a lot of sense. So it really is down to the core of the business and then how the management team is dealing with the pandemic. We did see some interesting changes around switching from sell side transactions to maybe more of a capital raise transaction. And so being flexible is also something that's been interesting this year. And then I guess we all have different industries we cover. I think from my point of view, some industries that have been really popular in the past year and seem to be going forward include home health, fintech, natural and organic consumer products, and even digital gaming and, all the products that are keeping us busy while we're at home.
I can follow up to that. Also, there's a great group, M&A, the Alliance of M&A Advisors, and they did a COVID impact survey at the end of last year. Respondents were mostly M&A intermediaries, but then they also had a broad spectrum of professionals who responded, including legal, accounting, PE, valuations from all over the country. So it was a really good input from a broad base of individuals. And when COVID hit, they found that over half the deals were either suspended or terminated. But the sectors leading the deals that were getting completed were, in fact, manufacturing and healthcare, followed by IT and then food and beverage. So in alignment with what Cassie is seeing here in Colorado. And then for the deals going through, unfortunately, they did see valuations drop by an average of about 14%, with the highest drop in the energy sector and the lowest drop actually in financials. Buyers were mostly corporate, then followed by PE, and then by family office. And as you can imagine, the sectors with the most deals suspended or terminated were in recreation, entertainment, hospitality, unfortunately. But looking forward, new deals in the works are led again still by manufacturing, healthcare, food and beverage, and this time in the top was construction. So some good insight from that group. I would recommend looking again at M&A Advisors for their impact surveys if you're interested in more data.
Thank you, Hope. Yeah, that is really incredible data. I'll have to check it out after this. Yeah, I think the next question, is related in a sense, but also focused on predictability. So, we're anticipating a lot more deals happening in 2021 and the market being hot. But there's also kind of this appearance and anticipation, that the new administration will bring some more predictability to the M&A market. So I'm curious how your teams, Soraya, Cassie, and Tierney, are preparing to serve clients in 2021, given the current public health, political, and economic climate.
Yeah, so I actually have a different opinion about predictability. I think that 2021 will continue to be unpredictable because of the continued uncertainty and the changes that you mentioned in those different areas. I think it's still unclear what the fallout and negative impact is going to be, or if there are any improvements, what they are and how they're going to impact the trajectory of deal flow and companies, seeking to be part of an M&A this year. I think that what I'm telling companies for which I'm the COO is we just need to continue to plan for a multitude of possibilities. So we are in the midst of scenario planning to prepare for a variety of different scenarios. I think the only certainty is uncertainty. And again, like I said, companies that are well prepared are going to ride it out. So, kind of scenario plan, scale for the best, but plan for the worst is what I would say.
I would agree with you, Soraya. I mean, in the insurance marketplace, we're seeing a lot of disruption. The markets are definitely hardening. And I think all of this is going to lead to more uncertainty in 2021. We're seeing increased rates due to continued consolidation within the insurance industry, and climate change, of course, is also increasing those rates. We also saw in 2020 our markets were willing to work with some of our clients. They were willing to extend the policy terms for 6 months, for example, for no additional premium. To reduce payrolls and revenues to help alleviate some of the pain of having to pay these premiums when our clients were struggling. So I think that we'll see probably a bit of reduction in flexibility from our insurance markets.
On another, side of things, I'm not a tax expert, but we've definitely been seeing a lot of buyers and sellers considering potential tax changes that are coming up. So potentially under a new administration, capital gains taxes could move a pretty significant amount. And so while that's not likely to happen in 2021, it probably will happen in 2022. At least that's what it's looking like now. Could always change, but I think sellers and buyers need to be looking at that because, of course, if you're a seller, your net proceeds will be taxed and the rate will greatly affect you, but also the price that buyers might pay could be different because they're also paying taxes. They're also looking at all these different considerations. So, it's kind of hitting you twice. And so that's something you want to plan for. And I don't know if you could predict that kind of thing, but you definitely want to have some contingency plans.
So it sounds like the predictability anticipation may be debunked. I guess time will tell. So we'll have to do this again in the end of the year, 2022, and follow up. Next up, Hope and I were speaking earlier about business planning for M&A transactions. And one of the things that we're seeing business owners do is plan as far out as 3 to 5 years ahead of a merger or acquisition. And Vanessa and Soraya, I'm wondering from your consulting perspective, is this feasible? Are you seeing the same sort of planning, and how should sellers be thinking about planning for a potential long-term M&A deal?
Well, I definitely think more companies should do a 3 to 5 year planning start. It really depends on the company and what they're going through. A lot of companies are not going to be able to plan because they need to be acquired or go through a transaction sooner rather than later. But it's a really, really good idea to focus on your key metrics to get the highest multiple. So the longer you can show past performance on revenue and profitability, the more valuable you will be. So I think it's important to look inward at your strategic objectives as well as a SWOT analysis, looking at your strengths, weaknesses, opportunities, and threats, and understand what your key strengths and weaknesses are, because that's the kind of partner or strategic transaction you're going to want to look for. Somebody that shores up your strengths, somebody that plugs the gaps in your weaknesses, and also presents an opportunistic future for you. So putting together that strategic plan 3 to 5 years is important, and making sure that you're laser focused on your industry key metrics. Like I said, sometimes profitability is actually better than top line revenue, is what I see. If you decide that, for example, that a growth through strategic acquisitions should be part of your growth strategy, start to think about what key characteristics you would like to acquire. Those could be entering new markets, gaining capabilities and skill sets. In a time of economic uncertainty, I think it's important to really shore up those earnings and make sure you're steady Eddie through those 3 to 5 years. It's like what I like to say, don't try to do something crazy or go into another product line that's not proven. So to answer your question, yes, I think it's a good idea, advisable to put your strategic roadmap in place and begin to execute. One example before passing the baton to Soraya is, I was running a mortgage bank about 10 years ago, and it literally took us 2 years to get through that strategic planning and getting our house in order, really restructuring the whole firm during those 2 years to get those key metrics in line to what those buyers look for in a mortgage bank. And then 3 years in a row, we hit those metrics. And on our 5th year, we were acquired. So sometimes that's what you need to do. You need to make the hard choices early on. Soraya, what are your thoughts?
Yeah, I think that's a perfect handoff, right? From like the strategic planning and the visioning to then, my role as a COO is to then execute and implement and lead the team to execution of the deal. But you're absolutely right, Vanessa. It does start with the vision, and it does start with taking a look at where you want to be, and then you put the roadmap on how you get there. So I'm a practitioner of the EOS model, the Entrepreneurial Operating System model, and I act as an integrator, which is the COO for companies practicing that model. And it has a very prescribed process for that. Like you said, there's a visioning process of where do you want to be in 10 years, then you back it up to a 3-year plan, and then you back that up to a 1-year picture. And from there, you set very, very targeted objectives every 3 months to hit those goals. And as challenges and issues come up and roadblocks come up, you solution them, you come up with solutions, but you don't deviate from your path. So it's the execution piece after you've laid out the roadmap of where you want to go. The beauty of that process is if you say you want to exit in 3 years, then you're really marching down that road in a very targeted and specific way to get there. So all to say is it's necessary. It's not easy, but it is doable.
Thank you both. I think on the same topic of planning, I'm curious, Hope, from a personal finance perspective, especially given the current market, what trends and insights should sellers look out for in 2021 as they are preparing for a potential M&A transaction?
Yeah, so I think planning and preparation, getting your own plan in place is so imperative, but doing it independent of whatever's going to happen in the market is also crucial, because we can't foresee what the future of the market is going to do, or either help or hurt us based on timing. So while it would be wonderful to rely on trends or give predictions from a personal planning perspective, we just need to be prepared for all possibilities and to think long term. So for example, last year, even with a global pandemic, we had a positive market return. The S&P index is a widely used benchmark for market returns. It historically averages about 10% year over year, and last year it was over 15%. So it's not great to try to predict what the market's going to happen, but the best preparation you can do as a seller is to get a good perspective of what life looks like after the sale by doing all the what if scenarios. So try to model out what your future looks like and use advisors, friends, family to help you decide what your potential activity is going to be. So are you going to do investment in new companies? Are you going to be buying real estate? Are you going to be using specific insurance policies that might have upfront expenses? Model all of these ideas and thoughts against the potential growth of your wealth and your personal assets in the market, and then know how confident you can be with up and down markets and not rely on those to support your future retirement or investment, whatever you decide to do next. So I think sellers can definitely expect volatility in the markets, but you can gain a lot of confidence in your outlook by looking at the what if scenarios, and using experience from others or your advisors to know to ask questions about interest rates, market returns, different valuations in your business, timing. And then again, it's definitely an emotional experience. So how long you want to be involved in it, given all those unforeseen things that might happen in the market. Weighing out all those options in some what if scenarios and visualizing what that looks like for you could be really helpful.
Thank you. This concludes our first sort of phase of the conversation. I think, looking back on 2020 and lessons learned for 2021, there is this sense that, predictability isn't going to be certain going into this new year. And it's really important to have a team of advisors to help clients, navigate the potential unforeseen. Hopeful for a great year, but it's not a journey that should necessarily be traveled alone. In our next phase of the conversation, I really want to focus on preparing for a transaction. So, a company has decided it's going to sell, or a buyer has decided, on a target entity, and things are moving forward. Cassie, I'm wanting to understand from your investment banking standpoint, what can businesses do early on during a sell-side process to help advance a smooth closing of an M&A transaction?
Yeah, it's a great question. I was just thinking that the sell-side process is kind of like turning over every stone, but it's actually more like turning over every grain of sand. And so I just really like that image of someone poking into every single thing. And so, a typical sell-side process is probably 6 to 12 months. And there are a lot of different things that you want to do to make sure that goes smoothly versus a more painful process. From a financial perspective, I think 3 things come to mind. Number 1 would be being realistic and reasonable with your plan and your projections. So if you have a great plan that you're executed on, you want to make sure you're kind of hitting or exceeding that throughout the process. It helps build momentum and really, sell your skill sets rather than continually missing it. Number 2 would be to conduct a quality of earnings. Almost every buyer is going to conduct a quality of earnings, and so you should really go ahead and get that out of the way right at the beginning of a sell side process, so you know what your numbers are. You can negotiate better against that. And also, I think the past couple of years there's been studies of after you're under LOI, which is a pretty formal offer, almost 70% of deals that don't close is because something comes up at the buyer's quality of earnings. So you can save yourself a lot of time and money by doing that yourself ahead of time. And then number 3 would be really just to make sure you have a good handle on all your data. So tracking that customer or SKU level data for 3-5 years is going to be great, so that you can see that improvement in every kind of slice and dice that someone might want to see, and you don't have to bother your CFO every hour for a different report.
Yeah, I think following up on that last point, data privacy and compliance is going to become extremely important, more important than it already is going into 2021 with some of the new legislation. So yeah, great last point. And overall, I guess one follow-up question is, a necessary topic for 2021 will be the treatment of PPP loans in the M&A process. We're waiting on some updated guidance from the SBA, but from a diligence standpoint, how can sellers that obtained a Paycheck Protection Program or PPP loan in 2020 and may obtain new funds in 2021, given the recent changes, how can they prepare for closing and navigate the change in ownership requirements that will be necessitated by the process for any outstanding loans?
Yeah, I can definitely take that one as well. We've had a lot of deals close in the past few months that did have those PPP loans and navigated them a few different ways. And so what I would probably just advise is to work closely with your banker, make sure you have all the documentation you need and know the right people there. Like you said, the SBA guidance is changing almost every week. And so unless you want a second job of tracking that, it's probably best to rely on them. And then I think just make it aware within your team. We had a deal closing on December 23rd, and on the closing call, the lawyer notified everyone that we still needed a piece of documentation. And so it could have held up the deal, risked announcements to the team, and around the holidays, it was very sensitive. So definitely just recommend getting that kind of tied up, because there's many ways it could go into escrow, forgiveness, all different sorts of things.
Thank you. I think turning to a different topic on preparation, Tierney, your focus on high net worth insurance provides a really interesting and necessary viewpoint when planning for M&A transactions. At what point in the transaction should sellers get in touch with your team and begin planning from an insurance perspective? And I guess twofold, how can they set themselves up for success in that process?
Well, it's never too early for a seller to complete a risk management audit for their family and for their business. It's similar to, and this is a really simplified example, but it's similar to selling your house, right? Like, you don't leave dirty laundry all around the house and expect to get a good price for the home. And it's similar. When you're looking to sell your business, you want to make sure all your documents are in order. You want to make sure that the business is in prime working order. And so that insurance audit can certainly help with that. Additionally, as the seller is approaching this liquidity event, it's really important to protect this influx of cash with proper liability limits through the use of excess liability and umbrella liability policies. And typically there's an opportunity after the liquidity event to reevaluate and assess the assets. So for example, I've had families that have sold their business and they have equipment and cars that are still titled under the business name that didn't also transition at the sale. And so there's this span of time where we have to get the vehicles and the equipment retitled. We have to get it insured correctly. And in order to do that, it would be much better if we could do that prior to the liquidity event.
Yeah, the necessary evil of preparing and checking off all those boxes. So
Exactly.
I like your example of the dirty laundry around the house. Also applicable in Zoom meetings. So I hope turning to you, what are some key personal finance considerations for sellers to be thinking about when they're planning and preparing for a closing in 2021?
Yeah, preparation planning. The more you do ahead of time, I think just the better the end scenario. So when looking at personal finances, it's unrelated to the business. What do you and your family want life to look like after the business is sold, or after your exit, your capital raise and reduction of hours, whatever that looks like for you? It's really important to spend the time to figure out what you want it to look like, and then to work with your advisor team to understand what it's likely to look like based on the proceeds of the sale. So if you can determine how close those are, you're more prepared for a sale sooner. If there's a pretty big variance between the two, then your timing, the logistics, your plans might need to adjust accordingly. So hypothetically, if someone's looking to sell their company, they've used their entire focus for their life to build that company. They've put everything into it. They haven't really thought beyond it yet. And it's a big change that they need to start planning for. And if they've got a big number in their mind that they think the business is worth, it might not match to what their retirement dreams actually look like. So ask questions about what do you want to do after the exit? Is it retirement full of excitement for your family, or is it more stimulating for the mind? Do you want future investments to maintain your spending goals, or do you want future investments that you are a part of actively as an entrepreneur or as an investor? Do you want your kids to be taken care of should anything happen to you? Are there health issues? Are you purchasing various real estate properties? Talking with your advisors, they can help you kind of generate some of these ideas. Sometimes I think people kind of say, I don't know, and retirement becomes a very long, boring process before they get stimulated again. But sometimes ideas can be turned up for opportunity before the sale, so that you can really plan ahead of time to make sure that you are going into the sale with enough proceeds to support the lifestyle that you want and give you confidence when you get to the opportunity to sell. So awareness allows the sellers to not only be more confident in the sale preparation, but gives them more freedom to consider variations in the transaction.
Thank you. It just hones in on the idea that and necessary concept that preparation for this life-changing event is completely necessary. So I think our next question really segues well into post-closing considerations and looking at it kind of from that planning lens pre-closing. So Soraya and Vanessa, I'm curious, what types of activities can companies do pre-merger on the buy side, the sell side, to prepare for successful post-closing integration? Of course, every deal is different, but what are your key points and advice that you use to guide your clients through that transition process?
So there are many ways of looking at a pre-merger, and there's many different types of transactions, whether you're merging or you're acquiring someone or someone's acquiring you. But for the purposes of the examples, I'm going to talk about, a merger event. We look at 3 phases. The way we think about pre-merger planning is the planning phase, and the post-closing is the execution phase. So during this planning phase, once you identify a target, we look at 3 things, and that's internal capability analysis, discovery and due diligence, and a deal planning stage. So during the internal capability analysis, it's really to understand what value you're looking to gain, and basically use that as a roadmap to measure the other entity by performing a current state assessment and just a simple high-level organizational design and alignment workshop. And you'll be able to really see, can the teams align well together? Are the cultures also in sync? Are there going to be any disputes on titles? This is where we get hung up with 2 entities merging and titles are being consolidated. That usually becomes a little bit of a fight fest, I like to say. The other one is really discovery and due diligence. It's really doing a deeper dive into how the transaction meets your strategy and key objectives. So obviously going into that, auditing the books, conducting now what we call a combined SWOT analysis, identify those gaps and synergies and create a playbook for that integration strategy and really start to flesh that out. Figure out who's going to be your post-merger integration project manager or lead on that. You really want a third party to lead that integration work, because the people who are going to compose that post-merger integration team is going to be both companies, but you want a neutral party to guide the process. And we find that that's when some transactions fall apart too, is that detail that's being fleshed out. And finally, it's really that deal planning. Everything from agreeing on a name and logo. Another big little fight fest is we want to keep our colors, we want to keep our name, we have a better brand. So that's actually it takes longer than you think, just that little piece. And then just everything from looking at technology, IP, and property and governance standpoint. Really, when I think about governance, I think how the 2 boards are going to work well together in the C-suite. So it's really looking at that governance piece as well. Soraya, what are your thoughts as a COO?
Yeah, totally in agreement with all that. Yeah, my role is unique because I'm actually embedded in the business, and so typically as the COO, the role is it's up to me to implement the integration plan, to create and implement the integration plan, because a lot of those operating functions typically are my responsibility. I advise clients, and how we try to structure it is you're absolutely right. I've seen a lot of companies merge at the financial level, and go through a lot of work on marketing and branding and the numbers, et cetera, all very, very important. But where I've seen it kind of fail and fall apart and then really starts to dilute the value of the investment is at the operational level. And I'm by no means saying it's easy, but it's definitely something that can be navigated. I like to advise clients to start with the customer in mind. Start with the end in mind. Think about how we're going to service the customer. Who's the end customer going to be? Maybe it's a new customer perspective, and work backwards from that. A thorough understanding of how the customers are going to be served, products, process, systems, operations, people, is critical, because from there you can truly build an integration plan that identifies the information and the tools and areas of risk, and then you build a step-by-step plan around mitigating those risks and collapsing them into something seamless for the customer. I've seen scenarios examples where without the end user customer in mind, all of a sudden as you merge the entity, yes, you've got the brand, you've got the marketing, but customer delivery is impacted, the customer experience is impacted. And at the end of the day, that's really what matters. That's really where the rubber hits the road. So I would just say, in short, identify what is needed from a customer experience perspective, create the plan, and then execute accordingly.
Thank you both. This really helps with transitioning into the post-closing discussion. And I think, we'll start off with Cassie, Vanessa, and Soraya. Looking at post-closing considerations, failure has been mentioned a few times throughout our discussion, and briefly just the fact that some transactions fail post-closing because of some of the reasons that you just mentioned in the last response. So I guess digging a little bit deeper into that topic, according to the Harvard Business Review, a substantial amount of acquisitions fail. What are the most common reasons for this failure, whether it's pre-closing or post-closing? I think we can start with you, Cassie.
Sure. I'm sure we could all talk about this all day or all year long, but I'll probably just come at it from the perspective of kind of building right up to closing, doing all the purchase agreement documents, and maybe right after. And I'm sure the other ladies can talk more longer term, but I really think, any sort of M&A transaction is pretty much like the relationship. It's going to be a two-way street. And so like Hope and Tierney kind of covered, if the seller's not ready emotionally, financially, they could really just say, hey, tomorrow we're signing this document and I'm not ready, or I haven't thought about this, or things aren't in order. And so that's something that could just, come out of the blue and kind of cause a lot of disruption. I think a lot of that can build up to if there's the egos in mind or the cultures of your companies don't match up. And so that's something where, the numbers might look great, the terms might be great, but there's something that the seller's not really ready to do. And then the other side of things, if the story changes and it's no longer compelling for the buyer. So I think it kind of could be two different things. So either you have a large customer and they are going to cancel, or they're going to be acquired themselves same month that you wanted to be acquired. That just throws a wrench in things that no one foresaw. Or it just could be the case where there's not enthusiasm really about your company anymore. It wouldn't hurt the buyer to not buy you. If a competitor bought you, they wouldn't really gain anything maybe. And so there's a lot of different ways different buyers look at different things. And so I think, it's a heavy topic of all this failure, but I think having advisors along the way is really helpful, especially from investment banking role. We're often the bad cop kind of that comes in and negotiates harder terms or better things, so that hopefully after the deal, the culture, the operations and all that would be smooth. But yeah, I have a long list of other things that could go wrong as well.
So I agree a lot with what Cassie said and what Soraya has mentioned in the past about, the reasons why transactions fail is just being focused on that why. Be laser focused on how the transactions will augment your capabilities. And if it's not, do not proceed, because, like Cassie said, things get emotional, right? And all of a sudden you're acquiring your competitor. You're so happy. You're on cloud nine that you're acquiring that competitor, but you got to remember, return back to basics. What's the why? Why are you doing this? And I think if you lose sight of that, you could have a failure because of many other emotional factors. And like Soraya said, a lot of people focus on the financial side and not the rest of the stuff. And the second reason is the how, which is, I think, in my opinion, the biggest failure is putting the post-merger integration strategy framework and execution plan. Very few companies, trust me, will put these three things together post-merger. And I think that's the biggest piece, is the how. Soraya, what are your thoughts?
Yeah, I would agree. I look at it as kind of, I'll have it answered in two parts, kind of a lessons learned and best practice, and then what I would hope companies would try to do more of in 2021. I think that putting together the plan, like I talked about a few minutes ago, and looking at it from a customer impact perspective is going to be key, because again, delighting the customer is actually what drives revenue. Put together a plan, work backwards from that, and then execute against that operational integration plan. In terms of lessons learned for 2021, I would say companies that are going into deals weak, poor execution, lack of strategy, are going to be challenged fundamentally in any kind of scenario, but especially in an acquisition scenario. So I think what we're all saying is, get the right experts to not just help you plan if a potential M&A is in your future, but also to ride out any kind of uncertainty in 2021.
Thank you all for your insights on, planning, preparing for that post-closer integration. Tierney and Hope, I'm wondering, what are some common post-closing mistakes that sellers make when it comes to insurance and financial planning around their M&A transactions, and what are best practices for avoiding these mistakes? We've talked a lot about planning, but once we get into game time, how can we make sure we're prepared to avoid or recover from some common mistakes?
Sure. So yes, if you have the time to do this planning ahead, I know a lot of times sellers come into it in an emergency, or they wait to engage with an advisor team for wealth planning purposes until after, when there are actual proceeds. But if you have the foresight and the time to do it ahead of time, our team always works with the seller's tax and accounting advisors to make sure we're allocating funds to tax efficient investments and accounts. And I would say that instead of, there's mistakes, yes, they could have been done better, but they're more like missed opportunities. So you could have done it better if you had just chosen a different path ahead of time. So for buyers overall, there's sometimes it's waiting too long, not finding the right representation, only entertaining one buyer. But generally, for financial planning, it's waiting too long to engage, and you're missing out on the opportunities to really save from tax perspectives. And fortunately, the right wealth management teams are fiduciaries, so they're legally bound to keep your best interest first. They can be confidential, so you can trust them to not disclose your interest in potentially selling. They offer complimentary strategy meetings. So before working with the team, I'd just be sure to ask about those things and how your relationship will look long term, not just right at the transaction, but then ongoing after, to make sure that you're always getting the best opportunities and avoiding any potential mistakes.
Yeah, and I think to piggyback off of what Hope was saying, I think it's about hiring the right people. You don't have to do this alone. Get professionals that know what to do in the M&A space, so that you can be prepared and you can take advantage of all of the opportunities. From the insurance side, again, it's talking about some of those assets that aren't going to be sold with the business. Let's go ahead and title those into the personal name and shift them over to the personal insurance program. And then also talking about excess liability limits to protect that influx of cash. But, again, just asking those questions with your current advisors on what's their tenure, what's their specialization, and making sure that they're a good fit for you.
Thank you. I think I'll start over, sorry. Moving on to our next question, our last question actually is focused on remote work and capacities for integration given the current circumstances. We're all joining from our homes today. It would have looked different in 2019, not necessarily will it look different going forward as remote work capabilities continue to be accepted and a social norm when it comes to work cultures. So Vanessa and Soraya, with remote work on the rise given the pandemic and cultural adaptations, which, as I alluded to, we can expect to have a long-term impact. What insights are your teams taking away from 2020 and implementing into 2021 beyond remote work to make sure that post-merger integrations are successful? And how does this affect post-merger integrations, team setup for good and for bad?
Well, that's a great question. Being a consulting firm, we're used to getting on planes and being at client sites pretty much all over the world. And as a consulting firm, we adapted rather quickly to that virtual side of the house. So when it comes to setting up a post-merger integration team, it's really challenging enough because there's a diverse group of individuals, different agendas and motivations, and then you add that virtual factor. And we've seen a slowdown in our ability to implement in the first 100 days that full integration plan. So it has slowed down a bit of the cadence, and I think it will continue to, because we as consultants have to train our clients to get into that virtual integration piece. So we've had to, I would say, upgrade our methodology of post-merger integration work to be able to include a training component to our clients on that virtual piece. And it's hard not being able to be there present and, run down the hall, talk to the CFO and things like that. Because as Soraya will tell you, it's almost like herding cats, when you're the post-merger integration lead. So the way you set up the PMI team and structure, it's really based on that agreed upon integration strategy and objectives, and use that as a roadmap. And the integration project lead, like I said, will have a high-level plan and organizational design and just execute. I say execute the crap out of your plan in the first 100 days. So, and in just closing, the theme, like we've all been talking about, is getting the experts on board to be able to gain the efficiencies right away and not have it be an afterthought. Soraya, what's your experience on that battleground?
Yeah, for sure. I think that all my clients are remote, and even before the pandemic, actually. And I've had to lead actually one of them through exit planning through the pandemic. And I think the process and the risks of a team working together on something like an integration or an exit or an acquisition is the same. The difference in a remote team is that communication has to be a lot more thoughtful, frequent, and information sharing has to be a lot more crisp, I think. But you can do that today. It's highly doable with the tools that we have. I think the key part about putting together an effective integration team, Vanessa talked about the execution, but I think what helps with that is clearly defining the parameters up front, and who has decision-making power, and to be the tiebreaker, if you will, and making sure that all leaders are aligned and accountable towards kind of the greater good, and not maybe around a personal agenda, which is so difficult because there's usually a lot of tension and turf protection and other things going on. And this is where I think an independent person can help be the tiebreaker and be that voice of reason to actually get the job done, and to some extent, somewhat unemotionally walk down that road and make sure it gets done.
Thank you both so much. And to all of our panelists, this wraps up our full discussion on seller preparedness and pre and post closing considerations. I think we would be remiss not to go around and summarize our key takeaways and where people can find us. So Hope, I'll start with you, and we can go around the circle. But thank you all again for such a thoughtful conversation.
Well, thanks, Becky, for leading this panel. That was so well done. It was great to hear from all of these specialists and experts in their field. I think the key takeaway for me is to make sure you have a really strong group of advisors to help you. And I think any one of the women on this panel, I would highly recommend for sellers to consult at least discuss. It doesn't matter if you already have advisors. It's great to interview multiple to see who the best fits are and if they can open up some new ideas for you that you might not have considered yet.
Thank you. Vanessa?
I think we had a very great conversation. For those who are with us today listening, we're going to get your contact information and circulate this session. And hopefully you can reach out to any one of us. I think that we are your dream team. If you're looking for a transaction, we'd be more than happy to sit down with you and brainstorm. So feel free to reach out. That's what we're here for.
Thank you. Tierney?
Yeah, I mean, I think, just to piggyback again off of Hope and Vanessa, you don't have to do this alone. There are professionals out there that can help you, and anyone on this panel is certainly qualified and happy to assist. And thank you, Becky, for moderating. You did a great job, and I'm proud to be a part of a group of incredible women.
Thank you. Yeah, I like Vanessa's comment of the dream team. I'll take it. I agree. Soraya?
I think that my takeaway from the panel is plan. We don't know what 2021 is going to be. My favorite word was it's the predictabilities and the unpredictability. I think that absolutely reach out for advice, to scenario plan, to be prepared, whether your acquisition plans are imminent or they are, like we said, 3 to 5 years out. You have the resources there, and we can be of assistance.
Thank you. And last but not least, Cassie.
Yeah, this has been a great discussion today. I think my main takeaway for any business owner really is that, it's the start of a new year. It's great to set some goals and plans, but just like during the pandemic, you don't need to learn how to bake bread and do all these new skills and hobbies if you don't want to. Just like that, you don't need to pursue an M&A transaction this year. But if you are joining us today, it might be top of mind. So it could be good to start thinking about sell side, buy side, capital raise transactions, and get on the path to achieving some of those goals.
Thank you. Well, thanks to everyone for joining us. Thank you to our expert panel, and we'll leave it there. Here's to new year, new deals, and being prepared and planning for the unpredictable in 2021. So thanks, everyone.
Thank you.
Thank you.